Hi, I'm Suzy Rhoades, your financial training expert with PassMasters, here with some questions of the week. I wanted to make you aware that on our homepage at PassMasters.com, we have some free practice exams for you. So what we're going to do today is the free practice exams for the Series 65 exam. The practice exam is going to have one question for each topic that you will find within the PassMasters course. I wrote the course to follow the content outline as published by NASA. So this is going to be a 45 question exam. On your real test, some of these topics will have more than one question. So there are 130 questions that count on the actual Series 65 exam. So let's check it out. To find the free practice exams, go to our homepage, PassMasters.com, click on free practice exams, and then select your subject. In this case, we're going to be doing the Series 65. Start now. On this page, you'll learn a little bit about our course. So the course itself has over 2,700 practice exam questions. It's something I'm really proud of. I'm constantly adding new questions. There are detailed audio explanations, essential concepts to help with your retention. There's the cost. I'm your instructor, so my job is to help eliminate confusion. You can track your progress. There's over 20 hours of lectures, so online videos that you can start and stop and watch whenever it is convenient for you. We are a small business. We've been in the exam prep industry for financial services since I was a small child. I opened up my first school when I was 18. I started teaching insurance and securities classes when I was 25. So I've been doing this my whole life. I won't tell you how old I am, but more than half of my life, I've been teaching people just like you. So let's practice. Let's practice this Series 65 free exam. There is one question for every topic you'll find in the course. The Chief Compliance Officer of an investment advisory firm must review the firm's policies and procedures no less frequently than. Choices include semi-annually, annually, quarterly, and monthly. They must review the policies and procedures annually. So you click check answer, you know you got it right if you get that green check mark. You can also click show explanation. You can read the rationale and you can also listen. The Chief Compliance Officer of. So all of the videos are me. I write the content and it's me on the audio explanations. We have a small team that will help answer any questions you may have as you go throughout the course. We are here for you. Dave is an investment advisor representative working for a federally registered investment advisor. That's going to be key in this question. He has decided to change careers and leave the industry, who is responsible for notifying the administrator. So you as an individual, agent or IAR, always register at the state level. Because Dave is working for a federally registered investment advisor, it is Dave who will be responsible for notifying the administrator that he has left his firm. Gary owns his own advisory firm. He is an agent offering securities through XYZ broker-dealer as an independent contractor. Which of the following is true? XYZ cannot hire an agent as an independent contractor. That is false. Gary is responsible for supervising himself in his role as an agent. How can you supervise yourself? XYZ is not responsible for supervising Gary because he is not an employee of the firm. XYZ is responsible for supervising Gary in his capacity as an agent. That is the only one that is a true statement. I do want to say something about the questions on Series 65, especially lately. They're really long and wordy. Now, I can't make up long and wordy questions. So when you're in there taking the test, you have to breathe. You have to try to get to the gist of the question and give them what they're looking for. So if it's a really long question, my suggestion is always reading the last sentence first and then starting at the beginning so you know what you're looking for, and then read all four choices before you pick the best answer. So expect the test to be long and wordy. Catherine works as an administrative assistant at First Brokerage. Which of the following activities is she prohibited from engaging in? So notice Catherine is not registered. So what can't she do? Responding to an existing client's request for a quote, mailing information, she could do that. Making appointments, she could do that. Taking customers' orders over the phone. So if you weren't sure about A, by the time you get to D, you're super sure about D. She can't do that unless she is registered as a registered representative, an agent. Under the Uniform Securities Act, which is state securities law, federally covered securities are exempt from state securities law, except for which part of the act? The books and records provision, the advertising provisions, the securities registration provisions, or the anti-fraud provisions. Nothing is exempt from the anti-fraud provisions of the Uniform Securities Act. So exempt securities do not have to be registered. Exempt securities do not have to file sales and advertising. But nothing is exempt from the anti-fraud provisions of the Act. Under the Uniform Securities Act, which of the following are considered states? Very much expect to see these types of questions on the test. I call them STEM questions, or they're multiple multiples. It's a tricky way of making one question 4 questions. Puerto Rico, American Samoa, the District of Columbia, and Guam. Under the Uniform Securities Act, these are all considered states. Territories and possessions of the United States all fall within the state securities law definition of a state. Regulators are concerned when agents and investment advisor representatives use social media to communicate with their clients. From there, choices include laptops, desktops, mobile phones, and home computers. Are they concerned about any specific place that it's used? No, they'd be concerned about all of those places from which social media is used. Which of the following must be included in an investment advisor's business continuity plan? Procedures for the relocation of the office. Sounds reasonable. What if there was a fire or a tornado or a flood? Procedures to protect, backup, and recover books and records. I like that. Plans for alternate means of communication with stakeholders. Yes. Audited financial statements. No, they're not part of the investment advisor's business continuity plan. So 1, 2, and 3. Of the following debt issues, which has a maturity of 1 year or less? Treasury notes, Ginnie Mae bonds, Fannie Mae bonds, or money market instruments. The money market is where very close to cash securities trade. They have a maturity of 1 year or less. What is the tax equivalent yield of a 6.5 municipal bond to an investor in the 38% federal income tax bracket? This is when I suggest you use your scratch paper. So you have to get out a piece of scratch paper. At the test, they'll give you either scratch paper or an erasable whiteboard thing, which I just think fine. Why? But that's what they do sometimes, I guess, to save the trees. So you need that, and you need a handy dandy basic non-programmable calculator. So they'll give you something like this at the testing center, or they'll be on your computer, if I can talk today. On the computer, there will be a calculator. So one of the two, depends on where you take the test. So first off, when I have a question like this, tax equivalent yield of a 6.5 municipal bond. So municipal bonds interest is federally income tax free. Corporate bonds interest is taxable federally. We're going to assume both the corporate bond and the municipal bond interest is taxable at state levels. I know it's true that municipal bond interest is not taxable if the bond is purchased in the same state that the investor lives in. But our assumption for the test is otherwise. So we need to figure out how much does a corporate bond have to yield to be equal. So they do give you everything you need in this question. They give you the municipal bond yield, 6.5, and the investor's tax bracket, 38%. So here's where I really want your thinking to come in. The corporate bond is going to have to yield what? More or less to be equal? It's going to have to yield more. So if you punch in some numbers into your calculator and end up with a number that is less, you've done the calculation backwards. This is a common math question that students get kind of caught up in. They can never remember if they want to multiply or divide. So let's see what we get. So 6.5 on your calculator, you want to put it in as 0.065. So that's in its decimal form, divided by the complement of the tax bracket. So 100% minus the taxes that are owed. So you can do that calculation on your calculator. 100% minus 38%. So it is 62%. So 0.065 divided by 0.62 equals 0.1048387. Is there something that's close to that? Yes. Is it higher than 6.5? Yes. You're still not done. I highly suggest that you think yet further about what this means. So what this means is that the corporate bond yield of, we'll say 10.48, we will round it, the test won't take it out that far. How much of that do you get to keep after taxes? So in the equation to get to this 10.48, we divided, which gives us a larger number. The after-tax yield, or the tax-free equivalent of a corporate bond yielding 10.48, you multiply to get to the tax-free equivalent. So 0.1048 times how much of it do you get to keep? 100% of it, 38% of it, or 62%? You get to keep 62%. So times 0.62. I know what it better give me. 0.064999999. So 0.065. Did I get the question right? Yes. Double check your math. Always. So yes, this is a timed exam. It is not super common that people run out of time. If English is your second language, then sometimes that is an issue. You can get extended testing time. So you'll have to deal with FINRA, because they're the ones who give this test, even though it's written by NASA, as far as how to get extended testing time, because I'm not FINRA. But get that time if English is not your first language. I can't imagine taking this exam in German. I would fail miserably. So the tax equivalent yield of a 6.5 municipal bond to an investor in the 38% federal income tax bracket is 10.48%. I know that was a lot. Sometimes students really dread math, but it's really not a math-heavy test. 4 to 6 questions on math. That's the prediction. That's it. Which of the following bonds does not have reinvestment risk? 20-year mortgage bond, debenture, income bond, or zero coupon bond? So reinvestment risk has to do with a bond when it reaches maturity. You get paid back par value, and you can't invest that par value in another instrument that pays the same coupon rate or nominal yield. So a 20-year mortgage bond would have reinvestment risk. A debenture is an unsecured bond. It would also have reinvestment risk. An income bond is a bond that is only going to pay its interest if the corporation can afford it. The corporation is having financial difficulties. They might be reorganizing after a bankruptcy. A zero coupon bond, however, pays no interest. So a zero coupon bond is a bond that has been stripped, separate trading of registered interest and principal, and you're buying the face amount only. So that, let's say you paid $800 and in 10 years you get $1,000. That's when you earn the $200 difference. But there is no every 6 month interest payment being made to you. Thus, the zero coupon bond does not have reinvestment risk. That's a good one. When would an issuer call preferred stock? So preferred stock can be callable and bonds can be callable. An issuer likes it when they can call a bond. Think about your own personal life. Have you ever refinanced a house? When did you do that? When interest rates went up or when interest rates went down? Right? When interest rates go down enough. It's like paying off a credit card with a zero interest credit card. I've done that too. So we all do these things. It's the same concept for a callable preferred stock or callable bond. If interest rates have gone down enough that it makes sense to refinance so they can issue these instruments with a lower, in the case of preferred stock, fixed dividend rate, never a guaranteed dividend, but preferred stock has a fixed dividend rate. And in the case of a bond, a lower coupon or lower nominal yield. So when interest rates decrease is when an issuer would call preferred stock. So let's look at these other choices. When the economy is expanding, interest rates are usually going to go up. Preferred stock cannot be called. That's false. When interest rates are stable, no. So when interest rates decrease, an issuer could choose to call. It wouldn't make sense if interest rates have gone up to call preferred stock or a bond. Wouldn't make sense. The higher the discounted cash flow, the more blank the investment. The higher the discounted cash flow, the more valuable the investment. There's a whole conversation about how to do all that. It's in the course, I promise. An ETF trades most like corporate bonds, municipal bonds, common stocks, or open-end funds. An ETF trades in the secondary market. It stands for an exchange-traded fund. Open-end funds are redeemable. Exchange-traded funds are marketable. When the market is open, you can buy and sell an exchange-traded fund. If you're buying an open-end fund, you buy it at the price next determined, which open-end funds must value their shares a minimum of once every business day. They're required to do so at the close of the New York Stock Exchange. Bigger funds will do it at noon and again at the close. When you redeem your shares, you get the price next determined. It's always forward pricing with open-end funds. When you're buying a stock, you buy it at the next price. If it's a market order, you buy the stock at the next market price. Same thing with an ETF. An ETF trades most like common stocks. Hedge funds will do all of the following except. So what will a hedge fund not do? Determine their share price a minimum of once every business day at the close of the New York Stock Exchange. They will not do that. They are not required to do that. Open-end funds are required to do that, but hedge funds are not, so they don't. That's going to be the answer, I think, but let's check the other three. Invest in risky investments and use leverage to buy securities. Yes. Pay the investment manager both an annual fee and a percentage of the profits. Yes. Require investors maintain their investments for a minimum length of time. Yes. So the one that hedge funds do not do, they are not required to, and they do not voluntarily do, is determine their share price regularly. So when you have a hedge fund, it is hard to know what the value of your shares are worth. The main advantage of investing in open-end mutual funds is right of accumulation, breakpoints, forward pricing, or diversification. So the reason why mutual funds really are so popular is because they provide for diversification. So whether or not you buy an index fund that mirrors the S&P 500 or you buy a sector fund that's in the technology industry, you're not just buying one company's stock, you're buying lots of different companies' stocks. Diversification is the main advantage of investing in open-end mutual funds. Matilda has a portfolio of 1,000 shares of ABC and would like to generate some income. Which strategy would accomplish this goal? Oh, puts and calls. Let's see. She owns the stock. So there's two types of option contracts that Matilda could sell to create income. She could sell a call, which is an obligation to sell shares. Owning the stock covers the call. Or she could sell a put, which is an obligation to buy shares. Having cash covers the sale of a put. So she can sell puts on ABC. She can short ABC, which is to sell shares she does not own, but shares she has borrowed. So that's not have anything to do with options. Sell covered calls on ABC or buy calls on ABC. She'd like to generate some income. The income will be in the form of the premium collected on the covered calls that she sells. She has limited her upside profit potential, however, by selling those calls. Exchange traded notes are considered liquid and safe, include equity within their portfolio, pay periodic interest payments, or are a type of exchange-traded debt security offering a return that is linked to a market index. I'm going to give you a little bit of advice. Now, I'm not saying do this always, but if you have no idea, pick the longest answer. It is too long to be wrong. I've had students say the longest answer wasn't always right, Suzy. I know. I didn't say always pick the longest answer. The test is famous for having a really long answer that's really good except for one word is wrong, which means the whole thing is wrong. So in this question, maybe you didn't know what an exchange traded note is. I did, but maybe you didn't. So it is a type of exchange traded debt security offering a return that is linked to a market index. What product allows a terminally ill person the ability to sell his or her life insurance policy for more than the cash value but less than the face amount? Dark pool, black market, viatical settlement, or life settlement? So it is the viatical settlement in which the person must be terminally ill. So terminally ill is going to vary by state. Insurance law is regulated state by state by state. So viatical settlement. The value of a variable annuity prior to payout is which of the following? NAV per share, cash value, accumulation unit, or annuity unit. So prior to payout, we're in what we call pay in, where the value is in accumulation units. When you're in payout, you have annuity units. So a little bit about annuities on this exam. Which of the following is incorrect regarding variable life insurance? It requires the delivery of a prospectus since it is a securities product. True. The premiums are put into the insurer's separate account. True. It has a minimum guaranteed rate of return. It's a variable product. That is false. It has a fixed premium. True. So variable life has a fixed premium, but a variable rate of return. There is no minimum guaranteed rate of return in variable life insurance. So a little bit about life insurance too. Which is not an animal commodity? Lean hogs, live cattle, pork bellies, or milk? Milk is a dairy commodity. It is not an animal commodity. Which of the following is required to follow fiduciary rules? Agent, registered rep, broker-dealer, or registered investment advisor. So you can have a hat on that's broker-dealer and registered investment advisor. That's the firm level. But it's the actions that you engage in as a registered investment advisor and as an IAR, which was not a choice for this question, in which the fiduciary rule must be followed. Everything you do must be in the best interest of the client. Which is the most likely reason a client would buy growth stock? Income. Growth stock pays low to no dividends. Interest. Stock doesn't pay interest, it pays dividends. Capital appreciation. Growth. Or dividends. People buy growth stock for the price of the share in the market to go up, buy low, sell high. They don't buy it for dividend income. They definitely don't buy it for interest income. If they want interest income, they need to buy some bonds. In both the capital market line and in the efficient frontier, what is used to measure risk? Correlation, alpha, beta, or standard deviation. So these are some fairly complicated mathematical formulas that you don't necessarily have to know how to do the formula because you don't get a financial calculator, but you have to have a basic understanding of what components go into the formula. So for the capital market line in the efficient frontier, it is standard deviation that is used to measure risk. If we were looking at the security market line, then we would use beta to measure risk. Which is not used to measure volatility. So volatility is that up and down motion, right? Up and down stock prices over time. Alpha, the VIX, variance, standard deviation. So alpha is not used to measure volatility. Alpha is the return that is earned that's either more than or less than what is predicted using an equilibrium model, like the capital asset pricing model. So the VIX is a measurement of investors' expectations regarding volatility in the short term. Variance measures volatility, and standard deviation. Standard deviation is the mean of the means. When we have the standard deviation and a normal distribution, we can use the empirical rule to predict what the returns will be. We can figure out within one standard deviation plus or minus from the mean, the return will be 68% of the time. Within two standard deviations, up and down, the return will be 95% of the time. And within three standard deviations, we know the return will be up and down 99.7% of the time. We never know anything with 100% certainty. So it is of these alpha that is not used to measure volatility. When becoming a participant in an ERISA covered retirement plan, you must be given which of the following: an official statement, an annual report, a prospectus, or a summary plan description. When you're covered by an ERISA covered retirement plan, you must be given a summary plan description. All are true regarding HSAs, except what is false. You are eligible for an HSA if you are enrolled in Medicare. False. An HSA is a health savings account, and once you are enrolled in Medicare, you cannot fund an HSA. You can have one that you funded previous, but you cannot fund an HSA once you are enrolled in Medicare. So let's check the other three better be true. The earnings are free from state and federal taxes when used for medical expenses. True. Your balance rolls from year to year. True. Contributions made are tax deductible on your federal return, even if you do not itemize. True. So HSAs are really great places if you have a high deductible health plan that is HSA compatible. So those are important, but great places to stash some money for future medical expenses. So even all the way into needing nursing home care, long-term care. So nothing to look forward to, right? But it's a good way to, if you've got not very good health insurance, right? Which seems to be the only way that I can afford health insurance anymore. That is false. So it's right because it's wrong. Be careful. The test loves that. A qualified domestic relations order, so QDRO, QDRO, they're sometimes referred to, is a judgment for a retirement plan to pay any of the following except. So what can a QDRO not pay? Overdue rent, marital property rights, yes. Alimony, yes. Child support, yes. So the one that a QDRO cannot demand be paid is overdue rent. Company LMN declares a stock dividend of 20%. Nikki owns 1,000 shares of company LMN stock at $20 a share. Which of the following accurately reflects Nikki's position after the dividend has been distributed? Well, let's see. 20% of 1,000 is 200. So instead of a cash dividend, sometimes common stock pays a stock dividend. It is only common stock that can pay a stock dividend. Preferred stock can only pay their dividends in cash. So 20%, 200, 1,000, 1,200. But it didn't cost her anything. So she has 1,200 shares. But the price of the share can't stay the same. So once again, handy dandy calculator. How much does she have invested here? Well, she has 1,000 shares and they're at $20 a share. So that's $20,000. I know you could probably eyeball that, but there's something that happens when you go down to take these exams. You're like so nervous that you're not even acting like yourself, I swear. So use a calculator. Divided by how many shares does she have now? Not 1,000, but 1,200 gives us a share price of $16.67 a share. So another way to double check that, if you don't want to click to see if you got it right yet, I mean, not on the real test, you won't know until you finish the exam, of course, but I would double check 1,200 shares times 1667. So when a stock dividend is paid, it's still $20,000. 1667 times 1,200 shares is, 20,004, but that's just a slight rounding error. So same amount of money still. So always double check the math. A client earns 10% a year on a $10,000 investment. Inflation is 4%. What is the real return? So 10% a year total return. Inflation is 4%, so 10 minus 4. Real return is inflation adjusted return. So the real return is 6%. It's always great to earn something more than 0, but inflation is more than you're earning, right? So real return gives us an inflation adjusted return. Regular way settlement for buying listed option contracts is T+1. So trade date plus 1 day to settle. If you were buying stocks today, it is T+2, regular way settlement. This is set to change. So it is one of those regulations, it's really a rule that is already going to change, but not yet. And there's this weird thing that happens. So don't worry, when it changes, I'll update everything that's in the course. But sometimes it changes, but the test doesn't change for like 6 to 12 months afterwards. And that's really hard for me as someone trying to, help you pass a test. But that is something, it's correct as it stands today. When it does change, I will definitely let everybody know. An investor purchased 100 shares of stock for $10,000. If at the end of the year, the stock has increased in value to $10,200 and the shareholder reinvested $400 in dividends, his cost basis would be. Cost basis is the amount of money that's already been taxed that's in an investment. So the $10,000 is the original cost basis. The appreciation has nothing to do with cost basis. Reinvested dividends, however, are taxable in the year that they were paid. The dividends are taxable in the year of distribution. When they are reinvested, however, it does increase the investor's cost basis. So $10,000 plus the reinvested dividends of $400. The investor's cost basis is $10,400, which notice is more than the current value of the account. That's possible. So if they were to sell today, they would have a loss. The advance decline ratio is often used to highlight the market's momentum, available funds, sentiment, or breadth. Advance decline is often used to highlight the market's breadth. The capital asset pricing model is used to calculate the return that an investment blank achieve based upon the risk taken. That an investment will not be able to achieve is guaranteed to, should, or will. What's the best one to fill in that blank? Should. Nothing is ever guaranteed to earn anything. The capital asset pricing model is used to calculate the return that an investment should achieve based upon the risk taken. It's used to measure expected return. Where do securities trade at auction? The primary market, the NYSE, the NASDAQ, or over the counter? There are two secondary markets that we care about, the NYSE and the NASDAQ. So the NASDAQ is a negotiated marketplace where the dealers enter their bid and ask prices and trade between each other. There is the floor of the New York Stock Exchange. We have a specialist who is responsible for maintaining a fair and orderly marketplace at the auction, matching buyers and sellers. So today we use the term on the floor of the exchange designated market maker, but the test does like the term specialist. So it is the NYSE where the trades are done at auction. It's true today it's more of a hybrid marketplace where there is some negotiated and some auction. So the NYSE does have some electronic trading that takes place. But the NASDAQ really was the one that came out with that negotiated marketplace first. In comparing a traditional IPO to a SPAC IPO, what are some major differences? SPAC stands for Special Purpose Acquisition Company. So some major differences, 1, 2, 3, and 4. 1, so we're looking for 2 correct answers. The traditional IPO process is quicker than the SPAC IPO. That would be false. That's backwards. 2, so it's not 1. I can get rid of A and B. 2 has to be correct because it's in C and D. This is how I want you to do these questions. But 2, the SPAC IPO process is quicker than the traditional IPO is a true statement. 3, an investor in a traditional IPO can request a return of invested capital plus interest. No. 4, an investor in a SPAC IPO can request a return of invested capital plus interest. That is true. So SPAC IPO, 2 and 4. There's a lot of additional proposed regulations for the SPAC process. So they were really popular for a few years, but I don't know how popular they're going to be if that regulation goes forward. But they are on the test. A question. Brendan is analyzing the business cycle. If he believes the economy is about to enter a trough, what phase must we currently be in? So what are the phases of the business cycle? Expansion, growing, peak at the top, contraction, going down, trough. It's like the valley. So before the trough would be a contraction. Have to know the order of the 4 phases of the business cycle. We just never know how long they're going to last for, but we do know the order. Which of the following statements is true if the US dollar weakens? The dollar buys more foreign currency? Backwards. Foreign securities denominated in their domestic currency decrease in value to the US investor. An increase in US interest rates might strengthen the dollar. US exports become less competitive. So if the dollar weakens, US exports are going to become more competitive. So we're looking for which statement is true. The only one of those that is true is C. An increase in US interest rates might strengthen the dollar. So I want to talk about this here. Foreign securities denominated in their domestic currency would increase in value to the US investor when the US dollar weakens because the foreign currency strengthened. So when you convert back to US dollars, you get more US dollars than you would have gotten historically. So a weakening of the US dollar is good if you have foreign denominated investments. Interesting. Allie is considering buying a stock that trades on the NYSE. The stock has a beta of 1.30. She should expect this stock's volatility to be the same as the S&P 500. No, that would be a beta of 1. 30% more volatile than the S&P 500. I like that. 30% less volatile. No. 30% more volatile than the Wilshire 5000. No. Beta of 1 measures the market as a whole. The market as a whole is the S&P 500. So 30% more volatile than the S&P 500. You are reading the annual report for Disney. You notice that PricewaterhouseCoopers LLP has been the auditor since 1938. This is true. In their letter to the board, it states, in our opinion, the consolidated financial statements referred to above present fairly in all material respects the financial position of the company as of October 2nd, 2021 and on October 3rd, 2020. And the result of its operations and its cash flows for each of the 3 years in the period ended October 2nd, 2021, in conformity with accounting principles generally accepted in the United States of America. Which of the following types of opinions is this? So for publicly traded companies, the auditor, in this case, PricewaterhouseCoopers, has to write an opinion. Is it qualified, perfected, unqualified, or no opinion? If they find that everything is good, they write what's called an unqualified opinion. So a qualified opinion is not good. They found something wrong. As the corporation has grown, a corporate executive decides it is time for the company to buy a Learjet. The company has had many profitable years and will use its accumulated retained earnings to purchase the plane. An analyst interested in how this purchase will affect the corporation would want to examine which of the following: income statement, that's where you're going to find revenues and expenses; balance sheet, that's where you're going to find assets equals liabilities plus shareholders' equity; statement of cash flow; or Learjet's annual report. Well, definitely not that. So does anything in this question have to do with revenues created and expenses? No. Statement of cash flow looks at money coming in and money going out in 3 different areas. This Learjet, this plane, is going to be an asset, and the company is going to use cash to purchase it. And where do we find these items? On the company's balance sheet. Assets. You also find shareholders' equity on the balance sheet. Deshaun is reviewing the past performance on his portfolio. His annual returns have been 10%, 8%, 12%, 4%, 3%, and 5%. What is Deshaun's median return? So which one is the median? It's the one in the middle. Let's see how many of these are there. 1, 2, 3, 4, 5, 6. When there's an odd number, it's really easy to pick the one in the middle. You've got to put them in numerical order first. When it is an even number, as it is in this question, you've got to take the 2 numbers in the middle, add them together, and then find their average or their mean, divide by 2. So we've got -3, 4, 5, 8, 10, and then 12. So -3, 4. We're going to add together 5 and 8. Use your calculator. I'm an accountant. I can't think without my calculator. 5 plus 8 is 13. The one in the middle of those 2 is 6.5%. That is the median. Definitely have to know how to do that. In an attempt to control the economy, the Federal Reserve has raised interest rates for the past few years, but the market expectation is that they will now begin to lower them. Your client is concerned about the volatility of interest rates. Which of the following is a recommendation that does not have interest rate risk? Corporate bonds have interest rate risk because of their nominal yield. Their market price is inversely related to interest rate changes relative to the nominal yield, the tattoo on my chest, of the bond. So if interest rates go up, the market price goes down. If interest rates go down, the market price goes up. Preferred stocks have interest rate risk because they have a fixed dividend rate. And the teeter-totter story I just mentioned works for preferred stocks as well. Bank CDs, let's just say municipal bonds. Municipal bonds, just like corporate bonds, the teeter-totter story works. So price is inversely related to changes in interest rates versus the nominal yield or the coupon rate of the municipal bond, which leaves us with bank CDs. So bank CDs do not have interest rate risk because you're tying up your money for a period of time, 9 months, a year, 3 years, 5 years. You have reinvestment risk at maturity. Interest rates may have gone down. You might not be able to earn the 5% or 6% that you were earning. But during the time in which your money is in that 5-year CD or whatever it is, the bank has made you a promise. It's not a securities product at all. They've made you a promise to pay you whatever interest rate they've promised you. So bank CDs, they do not trade in the market. They do not have interest rate risk. Tyler is looking to make a qualified charitable distribution out of her IRA this year. She would like the distribution to count towards her RMD for this year. Tyler is 76 years old. Which of the following is required? So qualified charitable distributions can only be made out of IRAs, and in order for it to count toward our RMD, let's see, the funds must come out of the IRA by the RMD deadline, generally December 31st. I like that. Let's make sure the others are all wrong. The funds must be distributed to the IRA owner. No, if they're distributed to Tyler, then they are not considered a qualified charitable distribution. So that is not required. Tyler must distribute a minimum of, no, there's no minimum. Tyler must distribute her RMD amount to the charity but cannot distribute more than that. There's actually a limit for qualified charitable distributions out of an IRA of current tax code, $100,000 a year. That is set to be indexed, so it will change over time, but it's got a very high limit. So the only one that is true here is the funds must come out of the IRA by the RMD deadline, generally December 31st. So the only time it's not is that very first RMD. Let's finish our exam. All right, 100%. Now, wonderful job. Thank you so much. Remember, the real test is going to have longer, wordier questions. And I didn't do a full-on explanation of everything because this is one of the longest videos I've ever made. But I did want you to have some idea of what you can expect to see topic-wise within our course, definitely on your test. It's always good to practice these exams yourself. So just go to PassMasters.com and check out our free practice exams. Thank you so much for watching. Be sure to give this video a thumbs up, subscribe to our channel, and turn those notifications on. I'm always making new content for you guys. If you'd like to check out PassMasters course offerings, there is a link found in this video's description. If you have any questions at all, just ask me in the comments to this video. The Series 65 is a bear of an exam. On our homepage, you can click on our student testimonials and see what our students have to say. Thank you so much for watching. Keep up the good work. Happy studies.
You got this.